You are listening to Keystone's Stock Talk Podcast, episode 157. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook or via our 24-hour streaming radio station, pennystocks.fm. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. This week in our Ask Us Anything segment, we answer a couple questions about your stock portfolio, including how many stocks you should own and the simple process of constructing an equity portfolio. We also have two Your Stock Our Take segments for your listening pleasure. Our first Your Stock Our Take this week came in from a listener on Hollister Biosciences, symbol HOLL on the CNX, which operates as a licensed manufacturer and distributor of recreational cannabis and cannabis products, and distributes its products through an arrangement with cannabis distributor to licensed cannabis vendors in California and Arizona. The listener believes the company is significantly undervalued. We will let you know if we agree or not. Our second Your Stock Our Take comes in on HPQ-Silicon Resources Inc, symbol HPQ on the TSX Venture, a Quebec-based silicon solutions company that offers innovative silicon-based solutions and is developing a unique portfolio of high value-added silicon products sought after by battery and electric vehicle manufacturers. We take a quick look at the business and the valuations here. I'd like to welcome this week my co-hosts, Brennan and Aaron. How are you guys doing?
Salutations.
Welcome to both of you. Good. We just got through an election here once again, so big changes.
Yeah, I would say huge, well, not much change. Huge waste of time and money. That's all I'll really say about that. But I think you've got a couple things you want to touch on there.
Obviously, yeah. Not a big surprise to me. Another liberal minority government. I think we all know the election was completely, unnecessary. It's not even really something that needs to be discussed. It's just what changes is what we're going to see potentially going forward. And I would be a little bit concerned in a situation like this if the NDP, which didn't really gain much ground, I think that they gained a seat. If the Liberals continue to have to work with them, what I'm interested in seeing, what I'm hoping I don't see, is that the Liberals will move further towards their platform, and specifically for investors, for the stock market. One of the things that the NDP proposed was an increase in the capital gains tax from 50% to 75%. So that's the percentage of capital gains that would be added to your regular income and taxed at your regular rate. Right now it's 50%. The NDP wants to raise that to 75%. I don't think that's a good thing
basic
for the market.
taxation
that's a good thing for
capital
investors.
Gains is crazy.
I believe that in Canada, we really need to encourage and incentivize good decisions and investment. And I don't think increasing the capital gains rate is going to bring in a lot of money into the tax coffers. And I think it can really discourage investment once again and just encourage consumption, which is, I think, really we want to do the opposite, right? And having a healthy financial system, investment market, people saving money and investing money for their own to manage their own retirement or hit goals in the future. That's something that's really important. So, there is talk that one of the things that the Liberals could potentially do is adopt that policy. And there's some other policies as well that such as the wealth tax. I don't know if we really want to get into that, but the NDP proposed 1% wealth tax on people with net worth of 10 million or over. So that would be a pretty monumental change in the Canadian tax system. I'm not necessarily expecting that the Liberals would adopt that. I think that would be pretty extreme. The enforcement of that, I think, would be a mess. And the wealth tax, once again, I don't believe I believe in incentivizing good decisions, right? So when somebody earns the money, they pay tax on the money that they earn. They invest the money, they pay tax on the returns of those investments. They save the money. Should they then also have to pay taxes just on the money that they've accumulated over time? I mean, how many times are you going to tax the same dollar? So other countries have tried the wealth tax in Europe. The majority of them ended up abandoning it because the enforcement was a major issue. It didn't bring in as much money as what was initially predicted. Some of the countries still continue to do it, like Norway, Switzerland. In some cases, it's voluntary disclosure, so there's not really an enforcement issue. I'm not sure how the voluntary disclosure, exactly how it works. You would just, trust that people are providing you with the right information. But I really think that what we need to focus on is long-term prosperity and encouraging people to invest in themselves, invest in the market, save, and be more self-sufficient. And there's this populist narrative around the upper income bracket individuals not paying their fair share, and this is something that we see in the NDP. I don't want to talk about who people should vote for. I'm just giving my opinion on specific policy matters. We see in the NDP they talk a lot about the top income brackets not paying their fair share. The Liberals do it as well. Clearly, I think that people that are making money should pay tax, should contribute. But the idea in Canada, anyways, and I'm not talking about any information that's coming from the U.S. There's always, I think people get information from the U.S. and up here we just assume that it works the same way here. I'm talking Canada specifically. The narrative that upper income brackets don't pay their fair share is just completely false. So I did a little bit of research. You can go to Statistics Canada. You can get the exact figures on the percentage of total tax revenue that comes from each income bracket. So for instance, the top 1%, the top 10%, and you can see what percentage of total tax revenue that bracket is contributing provincially and federally. So if you just want to talk about the top 1%, so the top 1%, which is, we'll just look at the numbers here. I believe that, so this is as of 2018, these figures, but the top 1%, I believe, is over $255,000 a year. And those 1% of income earners pay over 20% of total tax revenue that comes into the country, both federally and provincially, total income tax. This wouldn't include any GST. So 1% of the top 1% pay over 20% of the tax. The top 10%, so this is income over $96,000 a year as of 2018, pay 55% of the tax, of the total income tax. So it's pretty clear that upper income people are paying a lot of tax in Canada, and they are paying their fair share. I'm not necessarily arguing that they need to pay substantially less. That's a totally different argument. But certainly the narrative that when you're talking about we need to tax upper income people more so that we can help the middle class out. Well, first we should really define what the middle class is, because if you look at the top 10%, 96,000 and up as of 2018, I mean, what 96,000 is worth as an income really depends a lot on where you live. I mean, if you live in some parts of Canada, you're doing great. If you live in some of the higher cost parts of Canada, like Vancouver and Toronto, you're not even really able to buy a house. Well, you're not able to buy a house, and you may be struggling to even buy a condominium. So I don't like the populism. I like straight facts. I like real facts. But I mean, I realize this is how politics is done nowadays. And just as another note, the bottom 50% of income earners, so these are people as of 2018 that were paying less than $36,000 a year. The percentage of total income tax that they provide to the coffers, both federally and provincially, is 5%. So, clearly there's a big disparity between what is being told and what the actual facts are. And I just think that whatever your opinion is, whoever you want to vote for, I don't like to get too much into politics. I don't tell people who to vote for, but I do think that it's important to understand, the facts, and you want to incentivize people to do well. You want to incentivize people to want to add value, build businesses, generate more and better products, and make money and invest. You want to incentivize good choices, and I think that that's something that politicians need to focus on more, as opposed to just the populism that we're seeing nowadays. But yeah, I'm certainly not hopeful that that's going to happen. As a matter of fact, I'm quite certain that it won't.
Yeah, and certainly closing loopholes, for example, the ultra-rich is something that most of us can get, that help them avoid taxes, something we can get behind. But again, it's probably a nuanced argument, and nobody wants to hear a nuanced argument today. But the taxation, you're talking about the NDP proposals there, that amounts to double taxation. You talked about this, wealth tax, capital gains, money that is the sitting government, whoever it is, has already had its hands on. It's taken a share. The NDP are looking to take more of that money, and that, you know, that money is used to create jobs and more wealth if it's invested. And it's just, to me, it doesn't make a lot of sense, right? And it's poorly thought out policy. There are other ways to do that. You can do a consumption tax. You know, we could go on and on about this, but
I'll just
Brennan's
note on the consumption tax as well is that here in North America, or in Canada anyways, the parties that are more on the left in terms of, and I don't mean slightly left of center, I mean that would consider themselves more socialist, tend to be against the VAT taxes, tend to be against things like GST, because they think that it impacts, they would call it regressive, they think that it impacts lower income people more. But if you look, but then they will also hold up examples like places like Sweden as a great example of a social democracy that we should aspire to. But if you look at those places, I mean, they do have high income taxes, but they have extremely high VAT taxes as well, and that's a major source of their revenue too. So it's you know, a lot of times you're hearing people argue with facts that aren't really facts, or things, you know, making points that they don't completely understand.
I mean, we could get into this and go further and deeper down the rabbit hole. I mean, my stance would more be reducing personal taxes, having a higher VAT or consumption tax. But I mean, again, those are not on the table for any. I don't see those arguments anywhere. And it's, you know, seems to be either some new ideas, or people want just, you know, they want the big quote, tax the ultra rich, and okay, let's move on. And you know, the discussion needs to be a little more detailed than that. And, you know, double taxation of capital gains, and like we talked about increasing the room for the TFSA. Those things are huge. Those aren't for the ultra rich. That's for average Canadians. That's for all of us out there who are looking to, you know, to invest and grow their capital. And, you know, it's something that our clients can use. The larger capital gains, or larger, TFSA contribution would be a great thing for investment for the little guy, not for the ultra rich. But anyways,
I'll just say, if anybody wants to take a look at the data that I was talking about percentage of income tax paid, you can go onto the StatsCan website. The best way, just Google high income tax filers in Canada, and that'll bring up.
Yeah, and maybe we'll have Yelena or Brennan tweet that out, like just a link to it. So yeah, it'd be a lot easy to do that if we can remember that. Brennan, you don't want to talk anymore about this, do you?
Not overly.
I'm gonna move on. Aaron, you got nothing else, right? Hockey season is here now. I'm far more excited about that at this point. And locally, our Canucks head coach, Travis Green, has his troops running through their annual rite of passage. It's a bag skate. It produced at least one puker, and we've seen images all over Twitter and social media about that. Another Canuck that shall we'll not name him, Olli Levy, was rolling around in the corner in starfish position just yesterday. So I remember back when we bag researched Brennan through about 1,000 stocks on CEDAR, and when he started kind of going into the corner, he went down, tried to lay down in fetal position, and Aaron was just all over him. We accept none of that around here, and I just wanted our listeners to know that you know, we go through 1,000 companies and we're not rolling around in the corner. So
definitely not.
Those images were kind of stark to see, right?
Yeah.
Well, Brennan tried. You remember that, right, Aaron?
I tried.
Oh, he tried. Yeah.
Yeah, but you wouldn't let him. But as a veteran.
It was almost like a drill sergeant, like you'd see like
Yes,
one of those
yes.
movies on like drill camp at the Marines. Like one of the new recruits, he's having a tough time. He drops on the ground, and the drill sergeant's just right over top of him, screaming in his face, like, "Get back on
You got that. You got him in line.
Yeah.
Basically, I mean, you guys always do whip me into shape. But yeah,
I got the job done though.
Exactly, and that is the key. I always do get the job done.
The job in that case was getting us coffee, but
I've done that a couple times. So
yeah, I mean, you could go into the corner and puke, but as long as you come back strong and go through another 500 companies, it's all fine. You pushed yourself, you had your moment, you come back, but you roll around on the ground. It's not something
I love when you do find a company though. Like there's been times where it's 10 o'clock and all of a sudden I think I found an opportunity, and I'll call Ryan or Aaron. I'll be like, it's obviously out of work hours, but it's like, hey, this is interesting, you should look at this. So it's like, it is fun, it's kind of exhilarating. Not that you get any adrenaline, but yeah, it's interesting.
Oh, you do. I swear, I said it on the podcast before. You go through 1,000 companies, you find one that you think can, be a huge winner over the long term, the one that's mispriced for our clients. It's exactly like Andy Dufresne in Shawshank. You crawl through a river of
you love that analogy.
Turds, basically, and you come out on the other side and the rain's going and you're cleaning yourself off. That's how we feel.
Yeah, and then
if you
5
can
minutes
get that
later,
image,
you find something else about the company that
that's a piece of crap. Then you're back into the sewer again. But once in a while, you do find those businesses.
Yeah.
So, anyways,
and just building.
Let's get into our mailbag. Or do you got something else?
All I wanted to say is just building off of the sports. I did think it was interesting. Last weekend, I had the chance to watch the Fortinet Golf Championship. So I think it's cool. A company that is under coverage, a great performer, is sponsoring a golf tournament, and I love golf. So I thought it was great. And I also just want to add, Max Homa did win, and my parents think that I am a spitting image of Max Homa. You be the judge, but anyways, that's all I wanted to say.
We'll look him up.
Yeah, look him up.
We didn't hear this ahead of time, but we'll definitely. Aaron's looking him up right now. I'm sure.
Yeah.
But yeah, it's along those lines. I mean, I remember we saw I think it was IndyCar circuit car with that Expel on it.
You're no Max Homa, Brandon.
This is
no Max Homa.
I agree.
Quite seeing it.
I agree.
You're more like beard, Max Power.
The beard, yeah.
This is just what my parents tell me. Hey, I didn't claim the glory, So yeah.
Or shall we say, Max Homa is no Brendan Habitler.
Yeah, I like that.
Yes.
That's a better way to put it. Yeah.
I think you're more. You look more like Max Bernier. That's who you look like. Let's not get into that at all. Anyways, yeah. No. All right, we're moving on. Let's get on to our mailbag. We had a few questions for our Ask Us Anything segment. This question, my question, I'm going to read it out here. It says, my question, I love your service and podcast. I have been mostly investing using another stock picking service. Oh, wow, we don't want to talk about that. No, I'm kidding. Where the volume of stocks was high. After 6 months with that service, my portfolio had 49 stocks. And there were more stocks being discussed daily. My portfolio became hard to manage and performance was poor. On your general advice, I have pared down my holdings. Generally, how many stocks should I hold? Lindsay, that was sent in via email. Okay, Lindsay, well, it's a great question. And I'm not here, not here on this podcast to throw shade on other advisors or stock picking services. But getting 49 buy recommendations in 6 months is really silly on many levels. Number one, I would say this criteria that they're using is not stringent enough. If you're finding 49 stocks that are great buys in 6 months, we typically look at thousands of companies to get you 3 to 5 recommendations over that period. In fact, in an average year, we're maybe targeting 10 to 15 across our services. And if the value is not there, it can be less. If we found 25 stocks, we would, but the whole point is quality over quantity. Number two would be that with 49 stocks, you basically bought the market. If you have any decent degree of diversification in there, less fees, you're just paying too many fees, and you might as well just buy an market ETF at that point, and you'll pay less fees and you'll just perform at the market. What we generally suggest is 15 to 25 stocks. That's the sweet spot we want our clients' portfolios to fall within. I always say this, diversification makes sense to a point. Generally, you don't want to have 2 to 3 stocks, even if like we or you have put in all the research in the world. It's too much what we call company-specific risk. I give this extreme example all the time. If you were going to hold stock in Tesla, that's a CEO-driven company. If its CEO, Tesla, Elon Musk, was, heaven forbid, to pass away, that would likely have a negative effect on the stock. You cannot mitigate this company-specific risk away if Tesla is 1 or 2 or 3 stocks you own. So that'd be well under diversified. But if it's one of 20, you can handle it and you can help allay that company-specific risk. On the flip side, we say no point in buying 50 to 150 plus stocks, creating a complex fee-heavy portfolio that mirrors the market. That's diversification. That's financial humor for you. So if you look at modern portfolio theory, you really get little benefit from adding just anywhere past 20 stocks to a reasonably diversified portfolio. So if you have those 40, 50, 150 stocks, all you do, again, you have that complex fee-heavy portfolio. It's hard to manage. You'll underperform the market due to those fees. It's not what anybody should be looking to accomplish. 15 to 25 stocks is our sweet spot. Do you guys want to add anything to that?
No, I think you'd hit the
just
nail
to
on
the
the head.
original question, when you're looking at a service that provides a large number of stocks, right? And we've seen there are many services out there.
Many.
You know, that might be decent in some cases for somebody who also really wants to do a lot of research on their own. Like you want to get 300 to 500 companies that you can research, but if for building a portfolio, as you say, it can actually be very overwhelming. And that's the feedback that we've gotten from people. Too much is just overwhelming. I mean, it doesn't really help you if you are provided with 300 stocks or 100 stocks and you want to reduce that down to 20 to 30 stocks or less, unless you're basically still having to do a lot of analysis yourself. So just as you said, Ryan, we believe in a more focused approach, a more simplified approach by just, smaller volume, more focus, and just making things less complicated.
Good. Yeah. So question 2 from the mailbag today builds off question 1. So I thought I'd add it. The question comes in from Ronnie S. I've heard you talk about building a stock portfolio with 20 individual stocks. Can you give me quick steps on how that process would work in practice? And he goes on to say, thanks. I bought Photon Control several years ago. Just got a big cash payout on the acquisition, looking to reinvest. Hopefully we see some new recommendations. Yeah, we are looking through a number of companies, so we should have some new recommendations upcoming. As far as the process, it's a great question. We get this and we talk about this in our webinars all the time. We kind of call our strategy focused diversification. You're looking to build that 15 to 25 stock portfolio, but gradually over a 12 to 24 month period, and that is key. Why do we want you to not buy 25 stocks on day one? Well, first of all, we're not likely going to have 25 screaming buys that we can have, but if you give us 24 months over that period, we can likely get you closer to that number. If you don't buy all at once, it reduces your risk or exposure to short-term market corrections. This is a strategy we have employed for decades with success. Provides flexibility to add positions as new opportunities come available. We're always looking. We're in the process right now in the US of looking at over 4,000 companies, and we will likely come out with some recommendations based on that. So as we add new companies or as companies' existing coverage come into a better buying range, you can add those over time. So the process itself is really quite simple. You use our stock recommendations via our client dashboard, or you're emailed our buy, sell, and hold reports that you're sent each month. Now, for example, if you became a client today, you can start with 3 to 5 initial positions. And then following that, every quarter, so 3 to 4 months, you're adding 2 to 3 new stocks as we come out with new research, and new research is available. You don't always have to, we put this, we add strategy as well. You don't always have to buy say it was 20 stocks you were going to buy, and you were going to buy 10,000 in each. You had $200,000 to employ, an equal weighted 10,000 in each. You don't have to buy that full 10,000 or full position on your first buy, we will provide advice saying buy a half position. So half of your 10,000 purchase in one of those individual stocks would be 5,000. You can underweight that position and gradually add to it as we advise over time. So hopefully that makes sense, gets you started, how many stocks you could buy, and a simple process for employing that strategy. That's what we provide all the time. I'm glad we had those questions to answer this week. Keep your questions coming into our Ask Us Anything segment, and we'll keep, anything financial we can answer. Stock related we'd prefer, but anything in the financial markets we can offer.
Yeah, I got one more.
Brennan,
here.
you had one, or did you guys want to add on that, or do you want to add your last question?
I have nothing to add there. I think that was good.
Good.
Yeah, perfect.
And
I've also
Brennan,
got
another question, right?
Yeah, I've got a question.
Twitter.
On Twitter, so as well, email us those Ask Us Anythings, tag us on Twitter. We'll try to answer it as soon as we can. So this comes in from @GrahamVoter. He says, markets are down, but key stock picks are up. Are companies with strong value and cash on hand also a hedge against volatility like gold? ? So, do you guys want to take that?
Yeah, I can start. In terms of, there's been a downturn in the markets generally, but it's not in all market segments. We've seen an uptick. Because we do research in different areas, we're in small cap, growthier oriented value and growth names, also into consistent dividend growth stocks, and then larger U.S. companies and value U.S. companies as well. For the course of this year, we've seen a shift into some of the quality dividend payers. Like, for example, Aaron, you recommended Boardwalk at the World Outlook Conference, but we had recommended it to clients earlier. It's had a tremendous performance this year. I think it's up 40%, not even including the dividend. For your little traditional boring little REIT, right? So not little, but boring REIT that has had a tremendous gain this year. So we've seen her cycling into that segment. Some of our big U.S. tech names have performed tremendously well this year. So, it just kind of shows you the importance of having that 15 to 25 stock portfolio, but diversified across, you have some large cap US tech, you have some Canadian REITs, solid dividend growth stocks, sprinkle in some of the smaller cap names that have value as well. And then you can have, if one segment of your portfolio isn't performing well, the returns can be pulled up by another segment because the market's always shifting in sentiment. We've talked about that just in the last couple months on the podcast. So Aaron, any thoughts on that?
It's really, as you said, it's about mixing the different types of companies, and there's always a focus on good, solid fundamentals, meaning a profitable business, a company that's growing, that whatever the business model is, that it has staying power and some visibility in it. But as you said, some of the companies that we like to invest in are those staple infrastructure style businesses that produce stable cash flow, good dividends, growing the dividends over time. But it's not necessarily going to be, knock the hat off your head kind of growth, but it's good, consistent growth over time. Those are what we'd consider more defensive names with a growth element. And then there's other ones that are, have a more exciting level of growth, but that are going to be higher risk.
More volatile though, right?
Yeah, exactly.
If you look at the Canadian small cap, almost 89% average return last year. You would expect a bit of a pullback, right? So likely in the more income related names weren't what the sentiment wasn't with that segment last year. So then you're seeing a shift to that this year. Now over the long term, it doesn't really phase us from year to year what a particular portfolio does. We're going to look 3 to 5 years out to see what our blended overall portfolio does. But you're going to expect some sentiment shifts. There's a lot of short-term money in the market, and you're going to see that. But, the overall theme is, and you talked about, good, solid, cash-producing businesses. In those segments, all of the companies, whether it be a growth-oriented company, a dividend growth stock, one of the largest tech stocks, several that we recommend and have been in our portfolio for years now, all of them still tick off all the same boxes in terms of having good balance sheets, good, reasonable growth prospects, trading at reasonable prices. So yeah, we have that theme all across these segments. As the hot money shifts around from, growth to value to income, your portfolio should have some of each of those within it if you're in an overall diversified portfolio. And you expect from year to year, one or two of the segments to outperform the others and one to lag, and then it probably picks up in a year or two from then. So that's why we construct a portfolio in that manner. So hopefully that answers that question, and we can move to our Your Stock, Our Take segments. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. We can start with Hollister Biosciences, Aaron. I think that came in from Ramon via YouTube.
Ramon via YouTube. He said, could you take a look at Hollister Biosciences? In my opinion, very undervalued. So happy to do that. Hollister Biosciences, the symbol is HOLL on the Canadian exchange. It's a 24-cent stock price, $65 million market cap. What this company does, they are a licensed manufacturer and distributor of recreational cannabis and cannabis products in the states of California and Arizona right now. So some key points that I'll look at, that I'll cover. First of all, most microcap cannabis stocks don't have any financials to speak of, meaning no revenue or profit. Thankfully, Hollister does have some decent numbers that we can dig into. Revenue for Q2 was $17.6 million US, an increase of 107% year over year. And for the first 6 months of the year, revenue was $40.7 million US, up 330%. Hollister also reported profitability during the first 2 quarters of 2021 of about $3.5 million or 1 cent per share. With about 300 million shares outstanding, the company has to produce pretty significant earnings in order to register a decent amount of earnings per share. I would expect to see a share consolidation at some point. The company is targeting revenue of $70 million for the full year of 2021. No mention of earnings guidance, but this would be up from revenue of $30 million in 2020. And the balance sheet is decent with about $7 million in cash and just under $4 million in debt. So a few takeaways here. First off, I like the US focus. I like the strong revenue growth. There is a limited market in Canada, which is quite saturated. We've definitely seen better opportunities in the much larger developing US cannabis market. And the revenue that the company is producing right away puts them well ahead of most publicly traded cannabis stocks in US or in Canada. The company also reports an insider ownership of 50%. We like to see management and board aligned with shareholders, primarily for growth-oriented microcap stocks. There is that small amount of profitability, which again puts the company well ahead the vast majority of other listed cannabis companies. But on the other side, looking at the other end of the equation, one thing that I think the company could do a better job of is explaining their story and the growth opportunity. The company does provide some information on their products and markets, but after reviewing the press release, the corporate presentation, the MD&A, I wasn't really left with a great understanding of what will differentiate this company from its competitors. There is certainly a lot of growth in the US cannabis market, but there's also a lot of competition, and that competition is going to increase in the future. The best answer that I can see as far as how this company is going to differentiate itself from its competitors or what the advantage is right now is that they're already well established in a few markets with some brands. So this is certainly a factor, but it may not be enough given the size of the company. Profitability while present is still relatively small. And then also revenue was actually down from Q1 in Q2 from Q1. And it is expected to be lower in the second half of 2021 relative to the first half. So overall, I think that there are some decent fundamentals here, but it is a smaller operator still. It's high risk, it's higher risk, and the story is still developing in the sense that the sustainability of the revenue growth and the profitability are more uncertain than we would like. We have a company that we prefer in the cannabis space, which is much more established with more clear competitive advantages. For Keystone, Hollister is a company we certainly would monitor. It, as I said, it does have some good fundamentals, potentially some good potential going forward. We would be looking closely at the profitability over the next few quarters and into 2022, and as well any changes in the pace of revenue growth and developments in the growth strategy. Certainly a company that we can learn more about and monitor over time. but it's not something I would necessarily rush out to buy right now. Certainly not in any type of a large quantity.
Yeah, it's definitely a company we have on our monitor list. The growth solid this year. The thing Aaron pointed out, declining revenues over the second half of this year expected versus the first half. That would be something we'd keep a watch on. It is profitable in the last quarter, which is nice. Fully diluted, about over 300 million shares outstanding. So it's still less than half a cent per share in that quarter. And that's what happens when you have such a large amount of shares outstanding. So it's one that we continue to monitor and may go further into a good insider ownership, which is like what we like to see. But we do have a name in that sector right now that we prefer, significantly larger, trading at reasonable valuations as well. So, Brennan, you've got the next Your Stock, Our Take. It's time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. That was sent in about a company that we touched on, a company that owns about 10% of the shares in this, but it's HPQ-Silicon Resources Inc. You're gonna Quebec-based company. You're gonna dig into this one.
You bet.
Okay.
So this came in from Evan, and he just said, "Would be interested to hear your take on HPQ-Silicon Resources." So as Ryan said, HPQ-Silicon Resources, HPQ on the TSX Venture, currently trading at a price of about 69 cents and a market cap of 229 million. So the company specializes in the exploration of quartz located in Quebec, as well as development for its transformation into silicon, which is essentially important for batteries as well as EV vehicles, of course. And their key property right now is the Roncevaux property. And I believe they did some drilling in 2017, but I don't know too much about that project. I believe they're focusing more on their technology. So let's look at that technology right now. So they've got three primary developments right now. They've got their pure VAP quartz reduction reactors. And this technology is supposed to be a new green and low cost process that will allow HPQ to transform quartz into silicon metal. And it's this silicon metal that is important in lithium ion batteries, from my understanding. And they do have a 50 million ton per year pilot plant. Again, I'll say pilot plant, about to start in Q4 of 2021. Their second technology is their pure VAP nano silicon reactor. And this is a new process that will allow HPQ to go higher up into the silicon value chain by transforming the silicon produced by the previous technology into the nano materials that batteries and EV manufacturers are looking for. Now, right now, they're still just doing very small scale testing. So nothing substantial quite there yet. And then their last technology, a new plasma-based process that could convert silica into fumed silica in one step. And they plan to have a 50 million ton per year pilot plant starting in Q4 of 2022. So as you can see, there's some catalysts coming up, but nothing substantial quite yet. Now, as Ryan said, we did bring up Pyrogenesis in, I believe, last week's podcast. And this company actually made a strategic investment in HPQ of about 10% of the company's fully diluted shares. And essentially the reason for the investment is to expand their role as HPQ's technology provider for the family of silicon processes, could potentially benefit Pyrogenesis. Now, looking at the company's financial results, there's still no revenue. The company lost about $1 million last quarter. So generally, we would still highlight the company as speculative. And at June 30th, the company had about $7.6 million in cash and about $1 million in debt. And like the previous company, the cannabis company we just discussed, this company's share count is very high at about 360 million shares fully diluted. So considering the company's not even making a dime in earnings or generating any revenue, they'll definitely have to have more dilution in the future to keep their research and development and CapEx going. So keep that in mind. So, really this is an easy one to analyze. Generally speaking, it's an interesting story. The company is addressing lithium-ion battery technology and the EV market, which of course could be a huge opportunity. Now, if the technology development pays off, the company is able to prove upon its pilot plants coming online and begin generating sales, an investment in this company could potentially pay off. But, and this is a huge but, as we have mentioned with other companies based on a technology which is still under development, like Cielo Waste Solutions, we are not scientists or experts in the process of turning quartz into silicon metal. So we are completely relying on our trust that management is on the precipice of a great technology. And the question you would need to ask yourself is whether you want to place your hard-earned dollars in something that you may not truly understand. Now, I should also add here that, you could speculate that maybe Pyrogenesis could buy HPQ, but again, this is a huge speculation, and we wouldn't, tell anyone to invest on a company, based on a buyout. So at the end of the day, it is good to see some catalysts. They're bringing on some pilot plants essentially, but ultimately we would stay on the sidelines until we have more confidence in the business's proof of concept.
Yeah, I mean, I think it's a classic case. We often separate small cap companies into concept versus proof of concept stocks. HPQ, whatever the promise, remains what we would call a concept stock. Until a company has posted sales and then posted cash flow from those sales, it is a concept. This type of business holds a higher degree of risk. There are many companies out there that have the same market cap as this company or valuation that the market is giving them, which already have sales and earnings and have similar upside with less downside because they have, like Brendan said, that proof of concept. I'm not saying that one cannot speculate on a stock such as this, but like you said, it's higher risk. And the strategy of composing your portfolio with, say, 15 to 25 stocks that are just concept at that stage, it's a bad one. It is a poor strategy. I'm going to flat out tell you that right now. We prefer to have our clients compose their portfolios of 15 to 25 stocks that have a different profile, one that includes revenues and cash flow as a basic proof of concept to start at minimum. It's a market fallacy that once the company has a proof of concept, they have sales and cash flow, that you've already missed out. That is not the case. I'll give you many examples. I'll give you a couple right now. The best performing stock for the last 13, 14 years in all of Canada has had a significant, Boyd Group, had a significant proof of concept when we recommended it, had cash flow, had earnings, and traded at reasonable valuations. It also had all the blue sky upside that many of the concept stocks that you're pushed on today have. Now, it actually achieved these blue sky returns up over 10,000% over that time. The same could be said for a company like Expel, literally the best performing company basically to come out of Canada in the past 3-4 years. Proof of concept, profitable, growth, extreme upside potential. Stock went from $1.40 to it trades at $80, $85 today. Again, you don't have to sacrifice that blue sky upside to have these companies that already have the proof of concept. If you invest in concept stocks, you also have that extreme downside. You have downside when you even have investing in proof of concept stocks with cash flow and earnings. You're trying to mitigate that downside with an actual business relative to a company that has no proof of concept that can go to zero if things don't work out in line with what the expectations are. So hopefully that makes sense.
That proof of concept, like when a company has a proof of concept, the risk to reward profile is way more attractive. Like you said, if it is,
the risk to reward. It's a key point.
Exactly. If it's just concept, that risk is it's way more reward. Well, I mean, you still have the potential for the reward, but that risk is, what's Warren Buffett's number one rule of investing? Don't lose money. What's Warren Buffett's number 2 rule of investing? Refer to rule number 1, don't lose money. So again, that's what we're looking at.
Yeah, for sure. All right. Now, I think that finishes it off. Aaron, you got nothing left, right?
How can I improve on perfection, you guys?
I don't
laid it all out there.
That's true.
How kind?
Well, it's because you did limited talking today, right? So that's the... Now, okay, keep your questions coming to our Your Stock, Our Take segment. Ask us anything. Keep rating and reviewing us on iTunes. We can keep pumping out the good content that we do on a weekly basis. I'd like to thank everybody for listening and wish you all, as always, profitable investing.
Thank you all. Profitable investing.
Thanks, everyone.